Welcome to the Doo Divas Smells Like Money podcast. I'm your host, Suzan Chin-Taylor, CEO and founder of Creative Raven, the firm that helps wastewater industry contractors and manufacturers unlock the power of digital marketing, AI, and PR to boost sales and opportunities. Whether it's through our online marketing and lead generation programs or providing a fully outsourced marketing department, we are passionate about helping businesses in the wastewater and civil infrastructure sectors not just survive, but thrive in today's digital world. Each episode, I'll be bringing you expert tips and strategies to help you grow and succeed. Let's dive in. Well, hello, everybody, and welcome to this week's episode of the Doo Divas Smells Like Money podcast. Today, I have brought back Steve Selengut, who is the income coach, and he is author of Retirement Money Secrets. Now, we had Steve on, it's been a while now, but we had him on for a couple episodes to talk about exit strategies, whether you were an employee or a business owner, and making sure that you had enough to live the way that you want to live in retirement. And I know this is a little, offshoot of what I usually bring onto the show, being wastewater related. But as you know, if you've been listening for a while, I like to bring on guests to talk about subjects as they're related to our own personal business wellness, whether it be development, retirement, money, strategies. And so that's why I wanted Steve to come back on. And the topics that we're going to be talking about today is how to create income from your own income, from your earnings. One, tax hedge, but two, more importantly, having income that you've created from yourself to make it work hard for you for a number of reasons. One, perhaps to see you through a rough patch in your business. Two, maybe you'd like to expand and add other services to your already existing contracting business, and you really do not like the idea of having to go and take out a big loan and pay that back. You would rather, do this on your own steam. Or three, maybe you're in a mode that you want to do some merger and acquisition. Maybe there's another company that has a service that person is retiring out that you'd like to buy to expand your own business. And again, not have to rely on a bank. And so with that, I'm going to turn this over to the income coach into what are some of his words of wisdom if you're looking for ways to build income from your own income. Let's not give it to Uncle Sam. Let's make it work for us. Right, Steve?
Well, I don't really know how to keep it away from Uncle Sam.
Well, you have to give some to Uncle Sam, but there are ways that, we probably as business owners have not even thought about. How do we make our profits work harder for us?
Yeah. And there are ways that you can, there are tax exempt securities you can use. I mean, if you're an entrepreneur, if you're a business owner, you're probably in a pretty high tax bracket.
Yep.
So you can put your money in tax exempt municipal bonds. And if you happen to be in a state that taxes, that has its own tax as well, get away with federal, you can eliminate federal and state taxes on a good size investment income by investing in municipal securities. And I know most people are reluctant to buy individual bonds or municipal bonds. They're very complicated and they're not liquid. So people have to pay a markup to buy them and to sell them. They have to pay accrued interest to the person that they're buying them from. Even if they show on on your portfolio statement that they're way up in price, if you tried to sell it, you'd have to have the go-between take 3% of that, so they're just cumbersome to deal with. But with the vehicle that I use, with closed-end funds, which is a trust vehicle, just like a personal trust you develop for your own family and so on. It's a trust vehicle that's focused on income production only, not really growth. You can buy a whole portfolio of municipal bonds, hundreds of, all in Florida, if you're in Florida, or all in South Carolina, or all in Minnesota, wherever, Pennsylvania, and get tax-free income today in the 7% neighborhood. So if
Wow.
you're an entrepreneur and you're pumping out a lot of money, a lot of taxable money, which I know when I had a corporation, there are a lot of ways to reduce that amount. But if you're really successful, let's say it's a professional practice or something like that, and you're paying 30 or 40% in taxes, you can set up your portfolio, your personal portfolio, to produce 7% tax free, and that cash flow can be yours to do with what you want. I mean, that's a nice thing to know about. I'm sure um, not too many people, not too many financial advisors will even talk about um, closed-end funds, uh, mainly because they don't understand them, and they're not very sexy. They don't jump up in price by 30 or 40% every now and then so that you can feel rich. But what they do is they, month after month after month, they pay a stable distribution that you can either reinvest or say, okay, I'm going to start to use this as to create a reserve, for this endeavor I want to do, or I'm just going to keep building the amount of income so that when I sell this sucker, or when I start to do something else, I'll have enough income to be where I want to be, go where I want to go, and whatever means of transportation I prefer.
I love it. I love it. So tell us more about this in, like 101 layman's terms, because my father was quite an investor, but did a lot in the stock market because he understood it. And I remember a wise statement from my mother. She said, don't ever invest in something you don't understand, because that's how you can get burned. And so, because this is a really, it almost feels like a much better method than taking a risk on the stock market, which in my mind is, I hope I don't tick anybody off here by saying this, but I look at it as just big stakes legalized gambling, because it really is. Because I know from myself, during that horrific area of 2008, I lost a bit of what my father had left me as a legacy, and got out and decided to invest in real estate. But now, after having, talked to Steve a few times, I'm really thinking about exploring this vehicle that he is talking about with some of my, you know, ready
It's
retirement income. So tell me about how business owners, in a very simplest terms, how it works, how they can get involved, because like you were saying, there are some investment people or counselors that they might be working with that they'll ask about it, and they don't know even how to get them into it. So if this is something that's piquing someone's interest, how do they get started? What do they need to know? And what are the questions they need to ask so they don't get burned? No, it's a lot.
um, that's a lot of questions
Let's
to
take them one
throw
at a time.
to throw at an
What
old man
exactly
all at
is it?
once.
What exactly is it? And how do you get started?
Okay, well, the um, the closed end fund. Let's say, for example, I were to tell you, I am an investment manager. Not anymore. I'm an investment manager, and what I do is I develop a huge portfolio of municipal bonds from all over the country, and I have every state that has, a state municipal bond, and they are in a taxable state and they're tax exempt. I have a collection of all of these that I own and I manage for you, you know. Um, and what I do is I collect all that money and I send it out to you every month. And that's it. You don't have to do anything to try to buy the bonds from a broker. You don't have any markups to pay. I've already taken care of that. Um, so I own this huge uh, array, a diversified array of municipal bonds, and they're the second safest. Of course, today I don't know about the other one, but they're the second safest form of investment out there as far as your the as for the financial risk associated with them,
Mm.
because states, if they have have money problems, they just raise taxes and they get more money.
Yeah.
It's just like the federal government does. Um, so they're very low risk. Um, you don't have to worry. Okay, so that's what I own, and you'll say, "Hey, that sounds really really cool." So now I'm gonna say, and I've placed these all in a trust vehicle, and the trust vehicle has terms associated with it, and two of them are interesting. One is that I am required to pay to whoever owns a piece of the action, a piece of this trust, 95% of all the income, the net income after expenses that comes in. And the other thing about this trust vehicle, it allows me to operate just like your company does. When your company gets started, you usually borrow money or get money from people to help you. And then if they're owners, you just give them whatever you want to. But if they give you money and you owe them money in the form of bonds or loans or something, you pay them. Well, these types of closed-end funds allow me to borrow money from separate sources from a bank at whatever rate I can get. So if I can get a rate lower than the yield I'm getting from the securities I buy, we make money that way. So I can have some debt, buy a whole lot more municipal bonds, and pay you even more money because the income coming in from them is higher than what I'm paying. If interest rates go up and I can't do that anymore, that spread narrows and I find it too risky, I don't do it. But I do short-term borrowing and then I pay back the loans and the principal and so. Well, that's what a closed-end fund is. It's a
And
trust.
and
It's
so
a
you get
trust
right.
that has all these securities. It has the ability to borrow money to buy more securities if you think it's right, just like
Mhm.
you wouldn't pay 12% if you only could earn 6%,
No,
you know? No,
right.
you borrow at 2% if I can make 4%. I'll borrow at 3% if I can make 6%. Yeah, and so on. And it's required to give you 95% of the net income. So you pay the manager, you pay your interest. You don't have any housing or anything like that because you're in a big company, and that's it. And then all the income goes to the shareholders. 5% can be put back in. That's what a closed end fund is. Nothing scary, nothing that different.
Mhm.
But like I said earlier, it just ain't sexy. It's not going up in price. It goes up in price when interest rates go down. It goes down in price when interest rates goes up. But the amount it pays just keeps on coming. Okay. And the trust, you own shares in the trust. You don't own my securities. You own my company. You own shares in the company that's giving you this cash flow. And you can buy and sell those shares if you want to because they go up and down in price. They just don't go up and down in price a lot. So it's the same as a stock that pays a whole lot of money with a whole lot of securities inside that in this particular instance are all well-known uh, municipal bonds. They can be one state if you want to have a poorly diversified portfolio, or you can have them from all the states and some that specialize in particular state. And that's one way that a high net worth, high tax bracket person can set aside money from his earnings so that it's there for him when he needs it. And it can keep accumulating and accumulating and accumulating until he does. And
Mm.
not only that, if he gets a situation where he just sold his business and he's got a big tax crunch, he can actually borrow against those municipal bonds through collateralized programs, not through margin borrow if he needs to. So it's a vehicle that has everything needed for you. It ain't it's also not new. It's not a new kid on the block. Closed-end funds have been around 30 more years before mutual funds were invented
Hmm. Okay.
and over 100 years before ETFs. So back in the 1800s, like 150 years probably before ETFs. They were in the 1990s. So they're not new, But like I said, the Wall Street of today is makes its money and emphasizes growth in amount under management to its advisors, and it gets paid on amount under management. It does not get paid on providing high income to its clients. So these things are not included in your model portfolios. They're not included in 401ks. They're not included in the average type of investment portfolio they talk to you about. They will they will buy a brand new issue company before they'll buy something like this.
So, how do you find someone to help you that is, you call them of a financial manager that specializes in these kind of vehicles? I know you said you used to be one, now you do it for yourself.
Yeah,
You teach people how to do it. But if you're like, okay, I need to find someone in my area that I can talk to, you're saying that, your typical stockbroker, if you walk into, one of the big ones like Merrill Lynch, or I don't even, Salomon Smith Barney, whatever those names, that they're going to kind of look at you and go, what? Because I know
yeah. Well,
that's happened to me.
some
I've
of them will
asked.
say, "What's a closed-end fund?"
Yes.
Another one will say, "Oh, I know about them. They use leverage."
And then they try to talk you out of it.
They do. Leverage, of course, is borrowing to get things done. The average closed-end fund has about 30% leverage. The average company on a New York Stock Exchange has about between 50 and 60% leverage, or at least more than 30 anyway. Let's say 40%. So it's not uncommon in this type of vehicle. They want to compare them because it says fund, closed end fund. They think mutual fund. I heard a guy being interviewed by a Forbes person the other day, and he was trying to tell people that these closed-end funds were mutual funds. They're closed-end mutual funds. They're just like a mutual fund, but they do this. And, he just didn't understand them. And he was a financial advisor.
So there you go. It's like, I, I, I want to go down this rabbit hole with you, is that if you hear that, how, maybe help our listeners understand the difference. You kind of explained what it is, but if they try to tell you it's like something else, dispel that myth.
It's really not like either ETFs or mutual funds. Mutual funds, both mutual funds and ETFs, tie their price to the value of the securities inside their funds. Okay. The stock market, the price of Exxon has nothing to do with the book value of Exxon. It has to do with the popularity of the energy sector at that point in time, and what the supply and demand is. That's how CEFs, because when it doesn't matter whether the price of the securities inside go up and down, like we were talking about municipal bond funds. They're contractually, they're contracts. They pay a particular amount of money every 6 months, really, to the fund. The fund pays it out every month, but they have to pay that, whether their price is high or low, whether they're at a premium or a discount. They're still paying the same amount of money. It doesn't change. So the net asset value is meaningless in a closed-end fund because it has nothing to do with the price, just like a common stock on the New York Stock Exchange. Whereas a mutual fund, they change their price every night to make the total value of the fund divided by the number of shares outstanding equal the current price. They're manipulated. And the ETFs do the exact same thing. Every night they manipulate the price to equal number of shares divided into the value. So it's a totally different type of security. It's much more like a stock, but it's a stock whose purpose is to generate income, not to generate market value. You can buy any number.
There you go. There you go. That's the difference, is that it's to generate income versus market value and what it's worth, how Wall Street sees it.
Right. Because one thing for sure about market value, one thing you can't do with market value, you can't go into a store and say, "Hey, here's my portfolio. Look at my market value. I want to buy this, this, and this." The guy's going to look at you like you're nuts. He's going to say, "Money, you can't pay me with your statement that says you're a millionaire. I don't care if you're a millionaire. If you can't pay me the 9.99 I want for that product, get out of here."
Right.
And for most of the millionaire portfolios that you'll see, the amount of income generated by them will be less than 3%. Less than 3%. When $1 million worth of closed-end funds, a portfolio of those municipal bond funds would be paying you 7%. That's, let's say, a portfolio of 55 different municipal bond closed-end funds, various states and general, would be paying you over 7% today, or $70,000 tax-free on that $1 million.
Well, Steve, here comes the big question I'm sure is running through people's minds. Wow, this sounds pretty good. Maybe I should try a little of this and see what happens. What do they need as far as a starting point or an amount to get
You,
involved?
you can buy a share of the average, and we're just talking about municipal bonds because we were talking about, wealthy people in high tax brackets. This is a list, for example. The average price of a share of one of these stocks is $10.37.
So you
So if
could
you had
get
a
involved
thousand
with one of
dollars
these, you could get involved with one of these income vehicles for a small amount that you don't
money,
feel bad about risking. And who
right?
knows what's going to happen?
You could own all 50 of these for roughly $50,000,
Wow. And at the same time, you could start
yielding
getting involved.
7%.
You could start getting involved for as little as a couple $100 and just keep throwing a little
Right,
more at it every
right,
single month. You got to start somewhere, right?
right. Now we were just talking about the tax trees, but there are three distinct types of closed-end fund. There are those we just discussed. They specialize in tax exempt income. There are a whole nother 100 um, that I use that specialize in taxable income, and they're invested in things like corporate bonds, mortgages, preferred stocks. They'll probably own some individual stocks as well. Um, Real estate. They'll have real estate inside. They'll have REITs and MLPs and
Mhm.
BDCs and all varieties of income securities in them. And their average cost is about the same as
Oh,
and their average yield is right now above 10%
even better.
tax, but that's taxable. Then the third type of closed-end fund trust vehicles is the equity. And they have, and I'm very conservative, so I include any fund that has as much as 35% in the stock market. I consider it an equity, a growth fund. And there are equally another 100 of those. The average price is just a little bit more, less than around $15 or so, and their average yield is around 9% right now. And that's in the stock. And most of them pay monthly. Some pay quarterly. They have huge volumes inside, so they're well diversified. The average equity fund would own 225 stocks, all the big names. Like, you get all excited, you own some Nvidia, you own some Microsoft, you own some of those big names. You got them in these closed-end funds too. The only difference is these are professionally managed, and they're going to be, if it goes up 10%, the guy's going to take a profit. He's going to invest it in something else or go back into the same thing again. He's just going to keep making you money. His focus, generate income for my shareholders. Generate income for my shareholders. My When I was managing money for other people, I never ever owned a security that didn't pay some kind of money, dividends, interest, whatever. And I also took profits at a specific level. I always had a target for profit taking. Just like every entrepreneur has a price for his product. I've got this on my shelf in my store. It's got a markup of 12%. That probably stores it's much more than that. But let's say that when that somebody comes in the store, they can have that product for that price. I'm not going to say, prices are going up tomorrow. It's not a market. It's not a market. In most stores, it's not a market. In some places, like probably if I go to a bazaar somewhere when I'm away in India, I'll find somebody I can bargain with on the price. But you can't go into Walmart and bargain with the prices. All right. So it's a totally different type of investing. I find, I have a community, an income investing community in the school platform, and there's almost 600 members in there. And one of the things you hear them saying a lot is, geez, I've got 40% of my assets in the stock market, but I'm sleeping nights because I don't care if the market crashes tomorrow because my funds are going to continue to pay me this income. They always have. In all the other crashes, they've always continued to pay that income. So it's a whole different mindset where you're focused on income. It's a whole different level of comfort because you're not worried if it goes down. Most people think, look at what happened in 2008 in the financial crisis. A lot of my friends were just about 65 at that time. It was almost 20 years ago. I was around 60, 20 years ago, right? So we were all thinking about retirement. And those of us who had big 401ks, seven-figure 401ks, all of a sudden woke up one day and they only had 700,000 and they say, "Oh my God, I can't retire on 700,000. I had to have that million too." Well, people who were in closed-end funds, they woke up that day and they had 700,000 there as well, but it was still generating the exact same amount of income that it was generating when it was worth a million too. And since they didn't have to retire right away, if they and they didn't have to spend all that, they could reinvest it at 50% lower prices and have even more income. So it's a whole different way of looking at things when you start talking about income investing as opposed to growth investing. Um, it grows as well. I mean, when interest rates are low and the market is high, these things go up in price. It's just not spectacular. One of them, it's not like, hey, this CEF is making a gazillion dollars in AI. That's not what it is. You may have a CEF with a whole lot of AI companies, many of whom are doing well, but you don't see 200 companies at the top of the list as gazillionaires. You only see a very few that get that big. So it's a different type of investing. It's the income focus, and it's the ideal type of investing for entrepreneurs, young entrepreneurs, if they have the discipline to set money aside, because it'll build for them the income they need to branch out. It'll build for them the income to need to sell and start another one. It just gives you so much more flexibility, so much more freedom when you had that income. I was 34 years old and I was generating 4 times my salary in New York City in my investment portfolio. 4 times. So when I went home and said, I'm going to start doing this for other people, I'm not going to New York anymore, I didn't see any panic on anyone's face when I made that announcement because we were making more money than we needed anyway. So that's where you want to get. And you can only get that. You can't get that in a growth portfolio where you say, I got all this market value here, but if something goes wrong and it's something large enough that causes the stock market to go down, you no longer have that independence because a, a, a full-blown typical Wall Street portfolio isn't generating any income. It's not going to do it for you in a bad environment.
Well, Steve, you've given us a lot of food for thought. And one of the things that, we touched on is that just leaving the audience thinking about you know, an income vehicle like this that produces income, let's say you are getting ready to retire. I know, I'm looking towards that in the next few years, is that, well, I don't want to stop working, but what's next for Suzanne? And
Yeah.
won't it be nice to have this income that is coming in that's a little extra beyond what I've planned for maybe to be able to pursue some of those missions that I always thought about pursuing? Maybe it's charitable works, being able to do something for your favorite charity, or explore, say, setting up a new micro business. Maybe you were a person that, you know, your hobby has been stained glass art. And you've always thought, I'd really like to be one of those guys that makes things and does those weekend craft fairs and, just sells my stuff. I don't think I'm going to get rich on it, but imagine a vehicle like this enabling you to do the thing that you've always dreamt of doing, something that's near and dear to your heart, something that, fulfills you beyond work. We all hope that we love our work, but that, we all have that other side to us that, man, if I had the time or if I had the money, I'd love to do X, Y, or Z. And so thinking about investment like this is just one way to get you closer to those things that you might want to do in your so what's next chapter.
Right. Absolutely. Absolutely.
And
This
so,
is the way you
Steve,
have
you
to do
have
it.
a wonderful book that, I have glanced. I want to go back and really do a deep dive. I kind of like, pick, what do they call, pick and choose the things I was really interested in. He has a wonderful way of explaining complex concepts about, financial vehicles in a really easy to understand way to help you get started in the thing that we were speaking about today. So, Steve, give us the title of that book, and we'll have it in the show notes. Maybe you can give that to me after, of where they can purchase that online. I understand also that you have a Facebook group if people want to join and learn more about this subject.
Well, the book is Retirement Money Secrets. See?
Just
That's
like
what
your
it looks.
shirt, for those,
That's
he's
what it
wearing a
looks
shirt
like.
with the cover of his book. So for those of you who are just listening, it is Retirement Money Secrets by Steve Selengut.
And it's
And
available at Amazon and at Audible and at Draft to Digital and any place else you can think of. The big stores will just look it up and purchase it and get it for you. The Audible book is only available from Amazon though.
okay.
And there is an ebook form, both hard and soft covers. The what I have in addition to that is my website is theincomecoach.net, and on it I promote a income investing community called the RMS Income Investing Community. It's on the school platform, and it's a discussion group that has almost 600 members
Mm-hmm.
of all sorts of people from every different profession you can imagine and background, and all over the world, literally. Every continent except Antarctica
Okay.
is representative. And we talk about the ideas of income investing and how do you make that change from thinking in terms of market value and starting to think in terms of the income. And one thing we didn't touch on here is another stream of income, which is the profit taking that we do a lot of. Probably don't have time to get into that aspect, but we do in the community and in the book. And in fact, we just launched another community yesterday, which is a sister community, which is called the RMS Real Estate Community. So something that you might be interested in, but it teaches people who are in the real estate profession primarily how to, it's their plan B,
Very good.
moving from the high work, high overhead costs of a real estate profession to the no overhead, less cost income production from a secure quality batch of CEFs. And we just launched that today, basically,
Excellent. I'll
yesterday.
have to check that out.
Yeah.
Well,
So that's the things I've got going.
yeah. Well, Steve, I want to thank you for coming on to the show. It's just again, you're a wealth of knowledge in this subject. It just, I'm walking away going, I really need to think about that. And, I dressed in one of my typical salwar kameez today, and I have this picture that I took from Jaipur behind me because I'm so jealous. Steve and his lovely wife, thanks to their, retirement income and what you've been able to generate, they are going to go in first class
That's
on
true.
a junket to India, and they're getting to stay in some of India's best five-star hotels and see the wonders that that country has to offer. And, so Steve, I envy you. You're going to have to tell me what you thought of my second heart home country and how you enjoyed it. And so, again, thank you for coming on the show. Safe travels on your journey to India. And again, for those of you who are listening, I encourage you to avail yourself of the resources that Steve has talked about today. The book is fantastic. And to learn more, to set yourself up, for that next chapter, or maybe just I'm young and I really want to take my business to the next level. And how do I do that without borrowing from a bank? Well, we just talked about it today. Income investment to self-fund your own dreams. And so thank you again, Steve, and thank you, listeners, for tuning in. And until next time, keep it flowing. Thanks for tuning in to today's episode. If you're ready to take your marketing to the next level and start increasing sales and opportunities for your business, reach out to us at Creative Raven. We're here to help you thrive in the digital landscape. Visit creativeraven.com or click the link in the show notes below to schedule a call and learn how we can support your growth. If you enjoyed the insights on today's episode, be sure to hit subscribe so you'll never miss an update. Until next time, keep growing and keep it flowing.